Here we are at the start of 2026. What should you do? Welcome to Cup of Bull. My name is Michael Dunham. With me today is Patrick Fontana, the founder of Fontana Financial Planning.
Welcome, Michael. Cheers. Welcome to Cup of Bull.
So, Patrick, I'll turn the question over to you. Now that we are in 2026, what are some smart financial planning moves that people should be considering with the new year?
So we can get into the numbers and new limits to some degree, but the big thing in January is the doors open to the new year. So you can fund Roth IRAs. You can check your 401k contributions and make sure you're on track to max out. If you're doing Roth 401k, which we're huge fans of, you want to check on where your money's going to do Roth versus pre-tax, if it makes sense tax-wise. I think HSAs, the door opens up to fund again. And some of those things, the sooner you do it in the year and you get it in that tax-free wrapper, if it's possible, that's great to get that growth.
Yeah, a couple things I'll add to that. So one, with the 401k, the limit did go up. So if you're under the age of 50, $24,500 is how much you can defer into your 401k this year. If you are 50 or older, $32,500. And then if you are in the age range of turning 60 to 63, where you're eligible for the new super catch-up contribution, if your plan allows it, $35,750 is what you can defer via pre-tax or Roth contributions. One thing I'll add to that as well, there's a new law that went into effect this year where if you are making a catch-up contribution and you are considered a high income earner, which is somebody who made over $150,000 last year, you are required to make your catch-up contributions via Roth. So it's one thing to be aware of. And if you've been making catch-up contributions and you're a high earner, but you've been making pre-tax contributions, you may need to evaluate what your plan might require you to do to be able to continue making those contributions as a Roth contribution.
So business owners in particular, if you have kids on the payroll, the limit went from $7,000 for Roth IRA to $7,500. So if you were just paying them enough to be able to fund Roth IRA, you want to up those. The new standard deductions, which for a single person was $15,000, that went up a little bit. So if you're trying to maximize kind of the zero income tax bracket for business owner clients, know that those numbers went up a little bit. You don't want to wait too late in the year to make that adjustment.
$16,100 is the limit for standard deduction. So basically, if you have a child that you're adding to the payroll, they have no other income, you can pay them up to $16,100 and they pay no taxes federally on that income.
Excellent news. So 2026, beginning of the year, review where your money's going. Update for the new limits if you're on target for a old limit. If you hit one of those big ages where you're now eligible for a bigger contribution, age 50 for catch-ups, age 63 for the little 3-year window to do a little extra. Check with your plan, check with your contributions, and get on track for the new limits.
Yeah, the other thing I'll bring up is depending on when you're watching this, but if you're watching this before April 15th, there are certain account types that you actually still have the ability to make contributions to. So if you're a business owner, SEP IRA, you can still contribute to. If you're not a business owner, Roth IRA, as well as HSA, you have until April 15th to make those contributions. So hopefully you're buttoned up and you've already made your 2025 contributions. But if you have not, you do have the ability to make those contributions up until April 15th. One other change that I'll bring up that went into effect for 2026, we spoke earlier about the high standard deduction. So $16,100 if you file singly, $32,200, so double that if you're married and you file jointly. So a lot of people these days do not itemize their deductions. A lot of people take the standard deduction. For charity, what that means is a lot of people historically have not gotten a tax benefit for the charitable giving that they've done. And there's a change that's happening in 2026 where non-itemizers, so people who take the standard deduction, can actually deduct up to $2,000 worth of charitable giving. So that's a new thing that you weren't able to do up into this year. So if you do give to charity, I'll say one, if you've not been paying attention because you knew you weren't going to get a tax benefit, maybe beneficial to start paying attention to that. And then two, just being intentional about the dollar amount. So 2,000 is the total limit if you're married, 1,000 if you're single. So up to that point, you get a tax break if you give to charity and you don't itemize your taxes.
Makes a ton of sense, Michael. Let's update our numbers. And what are we going to do for 2026? Let's rebalance and tell Rich.
Rebalance with discipline. I will say we do have a 2026 annual limits guide that we have added to our website. So please feel free to visit our website and you can download a copy of that guide. And if you have any questions or if it'd be helpful for us to discuss your personal situation, we also do have a link down below in the show notes where you can connect with a member of our team to have an introductory call about your situation. With that,
thank you, Michael.